about to reveal exactly how smart money are building their positions and hunt for liquidity. By the end of the video, you'll learn how to avoid being a victim of market manipulation, and you'll also discover the sneaky traps set by big players to hunt your orders. You know the drill. Like, subscribe, and stick around for the full video. Imagine for a second that you are the biggest player in the market. What would you need to do to trap traders and make your profits at their expense? Well, you need to consider where is the liquidity, what might determine retail traders to take certain positions, and then consider the methods that need to be applied to seduce the average trader to actually enter a position. This is a three-step process. First, you need to convince retail traders to take positions. This technique is done by using a range of price movements to trick traders into taking a position in a given direction. This is basically setting up a trap. We'll talk about these traps later. Then, you instigate traders to become emotional and think irrationally. This involves quick price moves, spike candles, or fast and random price movements. And after retail traders are trapped, you then hunt their stops and reverse the price. This is the simplest definition of a market maker's activity. Now, remember what happened the last time your stops were hunted. You were induced to take a position, thinking price is going to move in a certain direction, or maybe you were triggered by the speed of a price movement. Then, once the trap has been set and you took the bait, price moved against you. So how to avoid this? Let's discuss the most common traps used by smart money. The Asian trading session is one of the main zones targeted by the smart money. In this example, we highlighted the Asian sessions. We see that the Asian session is not as liquid and volatile as other major trading sessions. And one of the most common strategies used by retail traders is to identify the trend and wait for the breakout outside of the Tokyo range. But if we look closer, we'll see that this is not a viable strategy. If we analyze these 3 consecutive Tokyo sessions, we see an interesting pattern. Range traders who have taken short positions at the top of the Asian range had their stop losses hunted outside of the range. Each time, the market reversed aggressively in the opposite direction. The upward movement outside of the range also enticed traders to take long positions, hoping for a breakout trade. So there's a second batch of traders who were trapped, long breakout traders. When you have a cluster of orders in a similar price zone, this zone will be targeted by big market players. So if range trading could lead to your stops being hunted, and breakout trades are also risky, how do you actually avoid the Tokyo trap? The good news is that when you know how a stop hunt works, you can employ strategies to prevent being hunted in the first place. Remember, one of the key ingredients to stop hunting is a cluster of stop-loss orders near a similar price. Stop-loss orders might be clustered together for 2 reasons. The market's pattern points people to place a stop-loss near similar levels, or traders place orders hoping for a breakout. The safest way is to enter after you spot a liquidity clearout, a move outside the range, and a quick retracement back inside of it. Buying at the top of the Tokyo range or selling at the bottom of the range is outdated and should be avoided. Smart money also induces traders to take the wrong direction by using sharp and aggressive moves near the high or low of the day. One of the ways of identifying that you are in the right place is that the market will seem to be quiet in consolidation and make a sharp move out of the range, faking the breakout. If you were to take a trade in the area of the high or the low of the day, you might notice that price has some activity. You'll see the quotations changing, but the actual movement is little. The ticks are moving up and down, suggesting that there's lots of activity, but in fact there is little movement. In this case, a reversal might be on the cards. The stop hunt involves a deliberate movement outside of the range to what will become the new high or low of the day. The stop hunt has two major objectives: to take out existing stops and to encourage traders to commit to new positions in a direction that is opposite to where the real trend is going to be. It is common to see price undergo a further price of accumulation, which induces traders to take further positions. And when there are enough positions, the price is moved in the direction of the true trend, and their stops will be triggered. Also, there is often a second move to the high or low of the day, and most of the time it will fail to take it out. This forms the typical M and W patterns. A wedge or a triangle is a common pattern which allows smart money to trap traders in both directions. In this example, you can observe that on the lower boundary of the wedge, the lows become slightly higher each time it comes down to the line. This has the effect of ensuring that none of the traders that are taking short positions in these regions can turn a profit. Similarly, on the upper boundary of the wedge, the same thing is happening, with each of the highs becoming progressively lower and trapping the higher level longs and pulling them down. There is no way of predicting which direction the price will break. This is determined by the net volumes that occur. In other words, if there is a greater buildup of short positions over the long positions, then the wedge will break up. During market open, the smart money trap novice traders to believe market is moving in one direction, but in fact, reversal is just around the corner. I call them morning reversals. Often, you will see prices moving in one direction very strongly from the opening bell. The momentum is so strong, it creates a parabolic curve. It makes you regret not entering early. But don't get trapped. This parabolic move often gets reversed. The psychology behind this is simple. The trend is healthy when it's made of average trend bars, consecutive trend bars, and small corrections. But when the momentum gets out of control, with such a parabolic curve, with large bars, and without pullbacks, the market control has to be restored. If price is only favoring one side, resistance will be met. Keep this in mind when you see volatile movements in the early morning. When you see clear signs of failure or exhaustion, counter it. Accumulation and distribution periods in the market are a constant process of exchange. The difficulty is to find what variables might indicate that the market is in the accumulation or a distribution phase. It's all very clear after the fact, but to find variables in the live market, it's a harder task. This phase starts with a resetting of a daily high or low. Then follows a period where tends to be little activity, and the market just cycles back and forth between two price points. After a while, the range begins to widen. This has the effect of triggering pending orders placed by breakout traders. Smart money gradually accumulate, as more and more traders begin to take the bait. However, when they are triggered, the price is quickly pulled away, and they will often be stopped out on the other side of the range, which is also widening. Your play here should be, in the first place, to find the spring, the fake breakout out of the accumulation phase, and then to trade in the opposite direction of this failed breakout. The move out of the consolidation area tends to be very sharp and short. The first thing you need to see is a large sideways consolidation area. Generally, the longer the consolidation, the more powerful the resulting thrust. Once the consolidation is underway, you look for the spring pattern. The spring is simply a false breakout of the accumulation area where weaker hands expect a larger retracement or a breakout. The market breaks out of the consolidation only to return inside the range. In a consolidation area after an uptrend, the spring would appear on the lower side of the range. In a consolidation area after a downtrend, the spring would appear on the upper side of the range. In the case of a bullish spring, a false breakout on the lower side of a consolidation area, the entry is when the market swings higher from the spring candle. I like this approach because you can even place a buy stop above the spring area, and any swing higher will activate the entry. Don't trust the high spread bars within a trading range. Often, you will see a large body candlestick with little or none wick taking a lot of space within a range. It looks very strong, but it can also trap a lot of traders to enter. Price is rotating inside the range, sometimes breaks out for a bit, flushing out weak players out of the market. But it is usually contained within an approximate range. If a large bar is taking all the space, there is actually no more room to move. Price has to reverse. Therefore, when you see a large body candle in the middle of the range, don't enter. It's a possible trap, so fade it. If you look in your chart history, you'll see that most large bars inside of the range are countered instead of being followed up. Another aspect to keep in mind, there are always traders on the other end of the giant bar, ready to counter it and scalp for a quick profit. If you pull up a chart, you can see large range bars are usually not followed up with continuation during a range. The psychology behind this is simple. Traders who profited from this large range candle are exiting. Therefore, there are more circumstances where a large body bar is followed with a small pause or even a pullback before it's continuing its trend. Here are other failed large body candles inside of a range. They are huge in size, but they are not representing any strength. They have no follow-up and are being countered one after another. As a side note, not all high spread bars are fake. The key is analyzing them within context. So be aware of the size of the range when scalping against these bars. If you want to see more videos like this one, leave us a like and subscribe. And check out our Academy program if you want to further level up your trading. Until next time.